there, everybody. Thanks a lot for joining me on this Monday afternoon market recap. An absolutely chaotic session that we have seen take place. As at the close on Monday, this is the chart of the S&P 500. Again, another gap and go to the downside. We have that of a long day dark Morobozu candlestick. The S&P 500 closing down over 7%, down 225 points. Again, this is the continuation of the waterfall sell-off. And what we've just achieved as at the close during today's session is the taking out the breakthrough and really what seems to be at this particular junction, the continuation below that of the final session that was created in the month of February of 2020. Again, this is just Friday's candlestick of the week just gone. It was at this particular stage holding up above this structural support, but that structural support, it has been absolutely kneecapped during today's session across the board, not only in the US financial market indices, but also across the global markets as well. The Dow Jones Industrial Average, you can see in the top right-hand corner of my screen here, down a further 2,000 points, an absolutely mammoth continuation of the waterfall sell-off that really began all the way up here at the midpoint of February of last month. This is really starting to become quite concerning, quite confronting as these markets continue to overshoot some of the more closer areas of structural support that we have identified. What this Monday afternoon market recap is going to do is really going to play into the narrative, or at least the discussion that we have had over the past number of weeks in that pro analysis class, whereby again we've been talking about the perimeters of structure essentially on the minor level, but also the perimeters on the intermediate level as well, whereby again, for most of the people who've been listening and following along, we haven't really done anything apart from up at or down at verified areas of either logical support and resistance. And if you're looking at the markets right now, just to really show you this in its entirety, is that if you go into the S&P 500, although it has been again an absolute bloodbath during today's session, if I can zoom on out into the weekly chart and just to show you this, where we were back in the Q4 of 2018, even previous to that during the 15-16 transition as well over here, is that you need to pay attention to, and this is bringing in more of the sort of the private analysis into this public forum, is that if you start looking at these decelerating fan lines, what we're starting to achieve right now, and this is really the silver lining when it comes to what we're seeing in the US financial markets, or at least that pertaining to the S&P 500, is that during this sell-off and even during Monday's session, is that we are getting closer and closer and closer to retesting, of course, the bullish macro trend line, which has been in effect since March of 2009. If you pay attention to this on my screen, again, this has been an estimation, or at least a pushing out of that trend line into the future. That's why this line on my screen is red, because we're not necessarily sure on a time duration as to when we're going to come on back down and interact with this. Again, this will be the first time since we are going to, or at least it appears to be that way as at the close on Monday, to come on back down and actually retest this area since, of course, December of 2018 during this V-bottom or V-shaped recovery out of the depths of what was quite a dramatic sell-off. Now, this sell-off that we're seeing at the moment is a lot more stronger. It's a lot more sort of ferocious. It's taking considerably less time. And at the same time, in percentage terms, we're pretty much closing now where we were back in the fourth quarter of 2018. Markets pushing into, technically speaking, bear market territory, whereby we're seeing the equity markets push towards 20, if not exceeding it, depending on some of the markets that you are looking at. But at the moment, you can see that we're closing down here at 2,746. This estimation, so to speak, is coming in at about 2,700 points on the S&P 500. So again, we're very close. We're within 50 points to definitively, most likely coming down and tagging the support area, whereby we could see the actual handbrake, the definitive handbrake pulled on this very quick waterfall sell-off, which again, we were looking at potentially seeing the bounce to close this window up here. Obviously, that has never happened. And when I'm referencing, of course, the perimeters of the market and trading the structural perimeters, when we're talking about the intermediate time frame, which is what I've been harping on for a number of months leading into the top back in February, is that we've highlighted, all right, certain locations on the chart whereby structural support makes a lot of sense, i.e., the retesting of this primary bullish trend line, again, which we haven't actually interacted with since the last quarter of 2018. And of course, what happens, one, if we see the reaction out of this support area, two, what happens if we rally back on up into this red resistance box, which is actually above this red resistance box over here, which is the gap formation, which has really begun, or at least established, what has now been that waterfall continuation in the bearish direction. And this is not only, of course, applicable to the S&P 500, but it's also very applicable to the Dow Jones and the Nasdaq as well on my screen at the moment. So again, the markets are absolutely being clubbed, right? There's no contention around that whatsoever. However, as dire as what it seems right now, and as bad as what it seems right now, yes, it can, of course, get particularly worse. But the silver lining to this analysis analysis, at this particular point is that with every further point drop that we make beyond that of Monday's session low, is just another point closer to one of those really important structural areas, technically speaking, for the big macro trend continuation on the US financial market indices. It's anyone's guess at this particular point if this trend line is going to hold. What I do think we can count on at this point is that these markets are going to slow at this trend line as institutional investors begin to wise up to the fact that we have come back down to this area repeatedly on a number of occasions since the establishment of the bull market in 2009 over here. You can see all of these past tags, and don't think for a moment that people are not looking at the continuation of this trend line. And by the time we've actually got here, and this is something that we've spoken about again in Pro over the past couple of weeks at least, is that we forecasted this moving towards more so that of a 30% decline, right? Remember up here, we put out a video and we're saying, well, probably halfway through that of the bearish sell-off. Well, the second half of that sell-off, even to my standards as well, it's come a lot sooner than what originally I thought it would. Again, I was participating, or at least expecting a little bit of a bullish bounce. It never came. It doesn't really bother us whatsoever. But now that we're seeing the bottom falling out of the market, maybe this is that time, so to speak, and I'm not suggesting this whatsoever for a moment when it comes to your own portfolio accounts, but maybe others out there around the world are going to wise up to the fact that if there was a critical area of support, a legitimate, logical area on the chart that made sense as to where they would potentially begin to put risk on instead of taking risk off, well, this is where it's going to be, down here at roughly 2,700 points on the S&P 500. Now, as I look at this, obviously we are tremendously oversold. You can see this on the Stokes, you can see it on the RSI. The MACD is falling off an absolute cliff. When we go out into the weekly time frame as well, look at the RSI. It's already pushing back into extreme oversold territory that we haven't seen since, again, surprise, surprise, 2018. And prior to that, surprise, surprise, all the way over here, back in the transition of 15 and 16 as well. So again, at an absolute sort of worst case scenario, which is simply going to blow on through this, I think that is the lesser, right, of the two potential probabilities of which, or at least the paths upon which these markets are going to take. At some point, there is going to be a legitimate counter trend reversal at this particular point on an intermediate time frame. That counter trend reversal, we're still looking at that being sold as a whole, but that relief bounce, it may come within 50 points of where we are currently closing at as at on Monday, based on the extension of this bullish trend line, which has been in effect since 2009. When I go on over into the Dow Jones Industrial Average again, about 4 weeks ago, you couldn't make this stuff up. It was almost as if something like this was, it had a complete 0% chance of actually playing out, right? I mean, if you were telling people up here that in a month's time we were going to be significantly lower on the Dow Jones, trading down here at 23,800, they probably would have called you crazy, or at least at the least thought it. But here we are, we've fallen off the cliff, we're moving lower. That trendline extension that I've just pointed out to you on the S&P 500, for me to bring this up on the Dow Jones Industrial Average, I have to actually go into a monthly chart, and that same price projection is coming in down here somewhere above 22,000. So again, it's about 1,800 points at an absolute sort of worst until we are going to interact with this trend line. And again, on all the other attempts of coming back down here, yes, it has continued to be volatile, but it's coincided with the weekly oscillators moving out of oversold territory, which is what we're at least moving into at the moment when you look at the weekly oscillators on the picture of the US financial market indices, taking into account, of course, the severe bearishness that has engulfed, right, the markets over the past 3 weeks or so now. But that trendline extension, that target, it's sitting down here anywhere between 23,000 and also 22,000 as, right, a rough extension, a rough estimate of the trend line, depending on the time frame or the fractal upon which you're looking at the market through. Now, again, for the NASDAQ was left today anyway with an interesting candle. You can see the big gap down, pretty much an inverse sort of doji, or at least a sort of a gravestone doji. It's not really showing up at the right location. Again, we've had similar sort of attempts like this, where by intra-session we have tried to stage at least a rally. That rally, again, was sold into the close, much like all of the other markets as well. But that same extension that I'm looking at on the NASDAQ itself is still down here at, say, 7,500 points. So we're closing up here just below 8,000 points. We still have a further 460 points to move. Again, that's less, obviously, than today's session being, I mean, pretty much we can call it 8% down across the board for the three closely followed US market indices. But this is going to be a very important sort of retest or tag of this primary bullish trend line. And again, it's going to give us, or at least signify the signposts as to where these markets are going to move further into 2020. I'm still, interestingly enough, relatively optimistic in the face of this bearishness. Again, I think temporarily, at least short term, it's been a little bit sort of blown out of perspective. Yes, I'm not sort of arguing against that of the bearish move. It makes sense on an intermediate time frame. A lot of people have very simply sidestepped all of the chaos, which is fantastic. But now it comes into the simple fact that, one, we still haven't established any bounce whatsoever. And again, that's fine. But number two, what you should be thinking about is now that we've taken out the structural support from 2 weeks ago, this may be that sort of flush out of the first sell wave, whereby if it doesn't show up here, again, I'm highlighting these lower targets for the continuation of the bullish trend line, which are, or at least should temporarily pull the handbrake, so to speak, on these markets drifting any lower. Obviously, we can assume at this particular point there's going to be intervention in the marketplace. There is going to be a changing of both monetary and fiscal policy. We'll keep an eye on that as well and see if there's any coordinated efforts by not only global governments, but also central banks around the world to see if they can at least change any policy to help at least stabilize these markets. But for the time being, at least, we are in a complete bloodbath. We are in a complete sort of bearish move, a waterfall bearish sell-off, which again has got us looking at these very important bullish trend lines, these macro trend lines, which have been in effect now for pretty much just over 10 years at this particular time. So a very long-winded bull market that we've been sitting through. Now, again, when you extend this out into the Russell 2000, when we start looking at market breadth, again, it's complete. Just a breakdown of this bullish trend line. If we go out into the monthly chart, have a look at this. It's the first time at this particular point, and again, we're quite early, obviously, in the month of March here, but we've now broken below the fourth decelerating fan line. So you can see 1, 2, 3, and 4 on my screen. Mind you that this past touch that we got, again, was back in the fourth quarter of 2018. Now that we're down 162 points, right, during or at least for the month, if I go into the weekly chart and just show you this for the first session at this week, down a further 135 points, we've once again established that gap. It's going to become, the question will become, the answer is going to be achieved by, what happens when the S&P, the Dow, and the Nasdaq hit their primary bullish trend lines? That's going to sort of answer and unlock the question on the Russell 2000. But at this particular point, again, short term across the board, we are collectively oversold to a very extreme extent. The market itself is gripped by complete fear, which is understandable as well. But again, generally, when you see the market in this type of sort of formation, or at least type of trading environment, it doesn't really last all that long. And that's really based off, again, intervention. Whether or not that's going to be any sustainable sort of solution to this longer term, we're going to have to move with the analysis. But as it stands right now, I'm trying to give you, of course, the silver lining mixed with, relatively speaking, the dark sort of clouds that have formed and are now really starting to bring that storm to the forefront at this particular point. So stay focused. Again, I wouldn't be jumping out to place any trades. Again, we've been looking to sidestep the majority of this or take very considered smaller positions if you are trying to allocate capital back into this market. But for the time being, we still don't have a legitimate structural support. And what we spoke about over the weekend, and this was really the lesser of the two options that we were looking at. Ideally, we were going to see if this Friday's candlestick was going to provide any temporary sort of support to see a push off from. Well, clearly that hasn't been the case. And it looks as though we're choosing path number 2, which is the retest of these primary bullish trend lines across the board in the US financial market indices. Okay. And again, globally speaking for that matter as well. Right. So again, follow along quite closely. I would encourage you not to be jumping out at this particular point and really placing any trades whatsoever, but understand that the perimeters, P for perimeter at this particular point, is where the best trades are going to come from. It's all about opening up the reward and, of course, limiting the risk on the trade itself. And we've highlighted those points. We've made it very clear over the weekend videos up at higher levels. And also, again, path number 2 being that lower area. Well, to me, it really looks as though it's taking the turn of path number 2, which was least expected as at the close of Friday last week. So the big determination of this market moving forward is what's going to happen down here at, say, 2,700 points on the S&P 500. If we begin to crack below this trend level over here, hold on, it's going to get even more ugly. But at this particular point, if there was any place where someone was going to pull the handbrake on this, it would be the equivalent of trading into the December lows of 2018. And I want you to understand that I'm not championing this type of recovery. May very well happen that way. I don't think it is. But at least a short-term stabilization and some staging rally or relief rally, which again is going to allow people to potentially take risk off the table if they haven't already done so, leading into what is still at this particular point that intermediate top. Also pay attention on the weekly timeframes. These are going to be your best friend as to the exhaustion of the first waterfall wave sell-off. in the past when we've come on back down into these oversold areas, it's coincided obviously with market bases, which again is still the establishment of that next subsequent higher low, which again we are still yet to come anywhere close to taking out, which would be all the way down here at say 2,300 points. So again, we're getting tests of the primary bullish trend level. It seems as though it's absolutely Armageddon out there, and yes, it is on a minor level of the trend. However, when you think about the three fractals working in synchronicity with each other, I think we can agree that on the intermediate time frame, which is working in conjunction with the primary macro bullish trend, this sell-off has been very fast, it's been very ferocious, and it's caught a lot of people off guard. And now they're just simply reacting emotionally, of course, to what the market is doing. And when you see the markets down, I think it's the biggest point drop outside of 1987, something along those lines today, statistically speaking. People are naturally going to be concerned. They're naturally going to be worried. But structurally at this point, and technically, right, applying Dow theory to this market, these markets, as crazy as this may seem or sound, they are still technically okay because we haven't taken out the macro swing lows of that most recent macro swing low back in December of 2018. And that still holds to be true until that factual event changes. But before we're going to at least attempt to flirt with that structural event, we've got these primary macro bullish trends to contend with, which is what I'm leaving you with as at this Monday afternoon market recap. So I just wanted to say congratulations to those who've just simply sidestepped a lot of this chaos Armageddon. I think it's still going to persist. Obviously, volatility is going to linger as well. But as it stands, we're getting very close to that really first legitimate support area, which we're going to be laser focused on over the coming sessions, if not over the coming weeks as well. And we're also going to be watching the state as to how oversold these markets move during the continuation of this waterfall sell-off, which again is showing really no signs outside of a couple of sessions of actually slowing up at this particular point. All of these past candlesticks, they are now gone, based off, of course, today's trading action as at the close on Monday. So be smart out there, be intelligent. Again, I wouldn't be jumping into this market at this particular point, or if you are, be taking very, very small positions based on very strict risk and money management principles. Otherwise, just watch the markets and watch very closely to this bullish trend line down here at these lower areas as well. All right, so I'll keep you updated during the week as this continues to unfold. For the time being, though, this is what you need to focus on down here. It's James signing off on behalf of Pivot Point Trading. All the best, everyone. Farewell.